Now it's time for state rankings with the Center Square, where we look at reports from different organizations ranking each state on a variety of issues. The latest today is about how transparent your state is with how they spend your tax dollars. Transparency scores for all 50 states worsened compared to the previous year, and that's according to public finance watchdog at Truth in Accounting. That finding released today from Truth in Accounting leaves taxpayers in all 50 states yearning for how their states ranked. Now, in TIA's Financial Transparency Score 2026 report, Truth in Accounting reviews and grades each state's audits, deferred items, off-balance sheet liabilities, timeliness of those reports, external auditors, and pension data timing. Now, each year, taxpayers read news in their local newspapers and even at the Center Square about how their state plans to spend their tax dollars. But sometimes there's little attention to where those tax dollars ultimately go. That's where annual comprehensive financial reports come in. Now, these reports come in at around 100 some odd pages, if not thousands of pages, for each state. Truth in Accounting reviews each state's audits, with the latest most being from 2024 spending levels. Now, their report shows overall transparency scores declined nationwide, with several states continuing to struggle with delayed reports, poor audit outcomes, and hidden retirement liabilities on the taxpayer dime. Now, as for certain kinds of audit outcomes, you're sure to hear about adverse opinions in the news, and those are bad opinions to get in an audit. But Truth in Accounting says governments face no consequences or few consequences when they receive a qualified or a disclaimer opinion. Now, what are some of the different levels of opinions? After a clean or unmodified opinion, TIA says a qualified opinion is the next step down, and it may note exceptions to the overall fair presentation, which can include the score of the audit. Now, an adverse opinion includes major exceptions or warnings. For instance, when the auditor believes that there are questions whether the firm can remain a going concern. A disclaimer of opinion arises if the auditor simply refuses to provide an opinion, given limitations on the score of and the scope of the audit, or if significant material weaknesses in the internal controls and reporting material mean that an opinion cannot be delivered. So how did your state perform? Well, overall, New Mexico and West Virginia earned the top scores, with each receiving 87 out of 100 points. Indiana rounds out the top three. New Mexico, West Virginia, and Indiana again being the top three, but if you add Maryland and New York, that rounds out the top five for the most transparent states. What about the bottom of the list? Connecticut, Georgia, North Carolina, all at the bottom three. The report says Connecticut and North Carolina didn't have audited financial reports for their largest pension plans, and a high percentage of complex and convoluted deferred items distorted their financial positions. Georgia received a disclaimer of opinion on its state's annual report, and it doesn't measure the net position liability using the same data as the annual report. The state also took 297 days to publish its annual report. California and Illinois had not published their 2024 state reports at the time that Truth in Accounting compiled their research. Now, their 2023 annual reports for Illinois and California each received a qualified opinion. Arizona was unable to substantiate more of its financial statements, including a discrepancy of over $231 million between the Arizona Department of Economic Security's cash balance and its bank records. But which states improved the most? Kentucky experienced the most significant improvements, with an 11-point gain, primarily because the state's annual report received a clean audit opinion in 2024 after receiving a qualified opinion the prior year. Delaware experienced the most significant decline in its transparency score, decreasing from 78 to 55. But again, overall, TIA says state transparency scores weakened from the previous year. Now, one major line that taxpayers pay for is for public sector pensions. Truth in Accounting said in 3 states they identified significant underreporting of retirement debt, largely due to the failure of including debt related to teachers' pensions on the state's balance sheets. Kansas, for example, had the highest percentage of hidden retirement liabilities at 65%, mainly because it didn't include the school division of the Kansas Public Employee Retirement System, despite the fact the state funds the public schools' contributions to the plan. Truth in Accounting also reporting that Michigan had the second highest percentage, 64%, because it excluded most of the public school employee retirement system liabilities, even though it also provides the majority of school funding to each district. In Oklahoma, Truth in Accounting said the state excluded 62% of its retirement liabilities and did not include most of the teachers' retirement system pension liabilities, despite providing 80% of its school district's funding. You can find the full report at truthinaccounting.org. Reporters for the Center Square digging deeper into particular states, and to get the latest there, subscribe for free to the newsletter at thecentersquare.com.